Hello and welcome to this session in which we will keep working with budget and budgeting concepts. And there are a few concepts we need to cover before we dive into the numbers, before we start to look at actual numbers that goes into a budget. And those topics that I will need to discuss with you today that related to budget and budgeting are the types of budgets, elements of a successful budgeting process. In the prior session, we looked at the budgeting process. In this session, we would look real quick at what are the elements, what are the factors, what are the indicators that we do have as an organization a good budgetary process, elements of a successful budgetary process, external factors influencing the budget. So when we're preparing a budget, which we will later, the concept of controllability in a budget. Now this concept of controllability will become very important when we will discuss variances, but we need to introduce it in this session. And last and not least, we would look at the criticism and limitation of a budget. Yes, the budget is great, but what are some criticism or limitation of a budget that usually comes from people who work for the company? Let's go ahead and discuss these 5 topics. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello everyone. Are you struggling with your CMA exam preparation? Do you feel that your review course is moving too fast, too brief, or not covering topics in depth? Well, if that's the case, at Farhat Lectures, we can help you. We build your confidence through in-depth explanation, not memorization or reading the slides. What we will do is we provide baby steps approach to break down complex topic so you can truly learn, understand the material. How do we do so? We offer video lectures, we offer practice MCQs, we offer true-false questions, we offer exercises, we offer the notes. Understanding the material is the first step in passing the exam. Once you understand the material, you have gained the confidence to pass, and you can pass with Farhat Lectures. What can you do now? Start your free trial. You have a 2-day free trial. Take a look at it. Give us a chance. Your risk is 0. You like it, you keep it. You don't like, you cancel. Give us a chance. We can help you pass the CMA exam.
Starting with types of budget. Organization could have more than one type of budget, different plans and budgets for various management levels and time frames. Specifically, we need to be familiar with 3 of those. The first one is a strategic plans and budget. This is for senior managers. They create these long-term plans, often spanning a decade or more, to guide the organizational directional goals like growth and market expansion. Here, the plans are very big, macro plan for many years. For example, we want to increase or double our market share. Intermediate plans and budget. Rather than senior manager, this is carried by middle managers. They focus on midterm plans up to 2 years to implement strategic goals through initiatives like product development and department improvement. Now, this plan, for example, in the first plan, we said we need to double our market share. And in the intermediate plan, we have a little bit more specific. The next 2 years, what will be doing? We'll be initiating product development, more concrete, to translate those strategic plans and budget. This is 2 of 3. The third budget is called the operational plan or the operational budget, and this is prepared by lower level management, focuses on 1 month to 1 year. This is the actionable plan. This ensures that daily tasks such as production schedule and sales targets align with the broader objectives. So this plan also does not conflict with the intermediate plan or the intermediate budgets or the strategic plans or the strategic budgets. But the operational plan, as it suggests, it put things into motion and will start to do the work. And this hierarchy ensures that daily operation, which is the operational plan, support the long-term strategic goals across all management levels. So all these plans are basically talking about the same thing, but one is more specific than the other. And the most specific is the operational plans and budget, which we will prepare one of them later on in details from A to Z. The next thing we will discuss is successful budgeting process. Now, to have a successful budgeting process, you need certain elements. You need to have certain signals or certain things that exist in the company. The first one is the support of senior management. The active involvement and endorsement by top management underline the budget's importance, enhancing its credibility and likelihood of success. And it's not only for budgeting. Anytime you need something to be working for a company, whether it's corporate governance, internal control, or budgeting, or anything else, you need senior management support. Without that, nothing works, because senior management support is what we call an internal control, the tone at the top. If those people are interested in the budget, then that culture will flow throughout the company. 2, participative budget and budget and manual. What does that mean? It means we need to include everything in a budget. And we talked about participating budget and how we create a budget in the prior session. It could be top down, bottom up. But the point is, involve all levels in the process. Why? Because you want to ensure greater acceptance and commitment. Also, you need to have a budget manual. What's a budget manual? Budget manual means everyone that's involved knows how a budget is created. Basically, a manual. 3, budget planning calendar. What is that? Well, this tool helps coordinate activities to ensure a clear schedules of deadline. We need deadlines. Part of the budget is it has dates, it has deadlines. We need those deadlines. Why? To make sure as a department you know what you need to do and by what date. We need you to give you that necessary information so you can do what? Take action to achieve those goals. 4, communications of goals and assumptions. Well, of course, clearly stating the goal is translated in a budget. So a budget, as we talked about earlier, it's quantifying those strategic goals. Quantifying means putting a number. And it doesn't get any clearer than that. And you communicate this information to whoever needs to know this information. Management, lower level management, and employees. And assumptions. When we prepare a budget, we make certain assumptions. Well, those assumptions need to be communicated clearly as well, because if those assumptions, for example, we assume that the economy will grow by 4%, GDP will grow by 4%, and inflation will go down. Well, those are the assumptions. If those assumption changes, well, we need to basically change, and we'll talk about budget revisions shortly. Coordination and integration, that's big part of a budget. Since department budgets are interdependent, we need to coordinate. Coordinated instructions and clear distribution guidelines help integrate all components into a cohesive master budget. And we will look at a master budget later on, and we will see how the whole budget interconnect. But this is called coordination and integration. If your budget is coordinated and integrated, that's a good thing. Last but not least is you have to have what's called lead time or planning and time management. You cannot have the budget like 2 days before the calendar or fiscal year start. Adequate planning. You need to give people time. An organized calendar allow for timely budget completion. And this prevent delays to make sure the budget are ready when the fiscal year begins. So you don't wait until the fiscal year or the calendar year begins to prepare your budget. Have a lead time. Everyone is prepared. And those what we call are successful elements of the budgeting process. Now let's discuss some factors that could influence budgeting, influence the budget, because the budget is not created in a void. So when the company sits down and they want to create a budget, they don't ignore everything outside the company, although it's a budget that's for the company itself, but it's not created in void. So strategic and budgeting decision is influenced by many other factors, not only the budgeting, but also strategic decision. One is the general economic factor, social factor, political factor, and we talked about those: consumer preferences and conditions, expected trends, financial resource availability. So those are factors that you have to take into account. How's the economy doing? If the economy is going down south, you are not going to project higher sales. And if you do project higher sales, they're not going to be materialized, and you are going to demoralize your management, your employees. So you have to take that into account. Those factors influence how to create a budget. Other factors you have to take into account our industry situation. This includes market share, regulatory measures, labor conditions, labor market conditions, competitor actions. For example, you budgeted certain number of labor hours for a certain rate. Then when we started the work, labor condition did change. So we have to change and we have to take that into account when we're preparing a budget. Also, rising input cost. That's going to change our budget to reflect higher expenses, and that's going to impact profit margin and cash flows. So it's not only one thing, many things will affect the budget, but specifically economic and industry situation. Financially distressed companies or those near bankruptcy will budget different than market leaders. And where you are as a company in your life, if you're in a financial distress situation, if you're in a growth stage, if you're in the mature stage, well, the way you prepare a budget is different. So we have to take all these factors into consideration. The next thing we will discuss is the concept of controllability when it comes to a budget. But what is controllability? It refers to the extent to which a manager can influence activities, revenues, and cost. Simply put, can the manager control? Is it under their control? Can they influence this revenue or expense? Because certain costs are controllable, others are not. Usually you don't control revenue. You would love to be able to control revenue, but you can't. We're talking about cost. So controllable cost that a manager can directly influence. It means the manager's decision, or the manager, let's say, sole decision, or the manager's discretion can influence that cost up or down. They can incur that cost, not incur that cost. This is called controllable cost. Non-controllable costs that are committed by higher level of the organization and the manager has no discretion over them. No, not controllable means the manager cannot make a decision one way or the other about this cost because they have no influence over this cost. Those are called non-controllable costs. Now, why do we need to talk about this? First, few costs or revenues, I would say I wouldn't talk about revenues because you really cannot control revenues, are solely influenced by one manager. So it's difficult to distinguish the effect of current management decision from those made by former management. So when you're looking at a cost and you want to evaluate a manager, and that's why we are discussing this, because the manager is interested in determining what's happening to their evaluation. Well, did you exceed the cost in the budget? Well, is this cost controllable or not? Can I control that cost? Or was it imposed on me, committed, and there's nothing I can do? That's why we have to know whether the cost is controllable or not, because the implication, if the manager responsibilities exceeds their control, it can lead to lower morale, reduced effort, and poor performance. Well, but if they cannot control that cost, they should not be blamed for that. It should not be reflection of their performance because this cost is non-controllable committed cost that the manager inherited and they have to live with it. So the principle of the controllability should be considered when using budgeting tool for managerial performance evaluation, specifically variances. When we talk about variances later, we will revisit this topic. But the budget would help us because the budget is the benchmark, the standard. This is what we have, and we're going to compare everything to that standard. Now, can we change the budget, revision to a budget? Sure, we could have significance. Let's talk about revisions to a budget. Can we make changes? Well, sure, we can make changes. Organization often face changes in the initial budget assumption throughout the year. Remember what we say, we make assumptions about economic conditions, labor condition, interest rate, market share, so on and so forth. So those assumptions could change. So policies must be in place to revise the budget as needed to reflect those changes. So if the interest rate, we thought we will be borrowing money at 5%, now interest rate went up to 8%. Well, this means we have to make changes to our budget because our interest expense will change. It's not like we exceeded our cost. The market conditions, the assumptions that we made initially, for example, if we planned to borrow $1 million and the interest rate we planned for is 10%, we say our interest expense will be $100,000. So let's assume interest expense went up to 13%. Now we have to commit, we have to expense $130,000. It's not because we exceeded the budget, because market condition changed. Take this example and reflect it on other things. Input cost. gasoline price went up, then we have to make a revision to the budget. So importance of flexibility is important in budgeting. Flexibility to adjust the budget is crucial for successful budget management. So without revision, managers might be burdened by unachievable budget target, leading to lower morale and productivity. Well, just go back to the interest rate example. If we need to borrow money and interest cost went up by 30,000, now this means that the project that we are working on, that we budgeted for, has an over expense of 30,000. Well, let's revise the budget. Let's not blame anyone, because those are assumptions that we made initially that did not materialize. Now, the question is, some assumptions are made by managers. Now, why did you make these assumptions? That's a different story. But conditions that are outside our control or our decision making. At the end of the day, don't forget that actual performance result and variance report gathered during the year provide insight for corrective actions. And that's why we do what? Variances. We prepare variance reports, and we're going to see that later on throughout the year. And as we prepare various variance report, we know what's happening and we can take corrective actions. Now, what are some criticism and limitations of the budgeting process or the budget in general? The first thing is there's that perception across the board cut. So when we cut something, a cost, we cut that cost across the board. While lower level managers and employees may feel that management resorts to uniform budget cuts. Well, why? Because maybe our division, our department is doing way better than another one because our product is still sellable. Why cutting our division? We need those resources. So there's that perception that when cuts are made in the budget, they're made everywhere. And this perception arises when management either avoid examining specific budget areas or making targeted cuts. And this happens when the cut is across the board. Let's cut everyone's budget by 10% or 15% or 20%. Well, yes, we need to cut the budget, but for certain areas, we should not treat all areas the same, because certain areas are losing money. Yes, let's cut the budget. Let's see what we can do to save money there. But other areas, they need that money to grow the business. The other thing about budgeting is there's an artificial time horizon that's embedded in it. Budgets are often set for 1 year period divided into a month or quarter. Yes, we need to do that to have variances. That's the reason, to keep track of what's happening, to get feedback on a monthly or quarterly basis. But what's that going to do? It's going to restrict flexibility and responsiveness as managers feel constrained by these deadlines. What does that mean? As a manager, sometimes it may take you a month or two at the beginning of the year to increase your awareness for the product, advertising efforts. So for the first 1 or 2 months, your sales may not be as expected. Well, if we do variances, well, we plan to sell, let's assume for simplicity, 12,000 units, and we said we're going to sell of those 12,000 units, 1,000 units per month. And the first month and the second month, we didn't sell anything yet. And the reason is because we are still trying to build the brand awareness. Well, if we evaluate the managers on the first and second month, those artificial time horizons, they're going to look like they're not doing a good job, and their budget might be cut, or they might, that might reflect negatively on them. So there's those artificial time horizons that you have to take into account. And one of the limitations of the budget, reluctance to revise budgets. Some companies, what they do, once they create a budget, that's it. It's written in stone. They don't want to deal with it. They don't want to make any changes. Well, that's a problem. They are hesitant to adjust the budget once set. And remember, if assumptions change, if economic conditions change, we have to do that. Well-crafted budget may require revision to stay relevant in changing environment. And that's the key. We live in a changing world. The environment is constantly changing. As the environment changes, we need to change our budget. Let's take a look at this multiple choice question from farhatlectures.com. Which principles explain why managers are evaluated on cost that directly control? So when we evaluate the manager, we evaluate them on costs that they directly control. And what's that principle? Is it the budgeting continuity, budget revision flexibility, controllability, rolling budget? And I hope the word directly control lead you to the controllability concept. Controllability means, can the manager influence by themselves this cost? If the reason is yes, then you evaluate them. whether they exceeded or not exceeded that cost. Now, the other terms you need to be familiar with: budget continuity relate to the budgeting update, not any responsibility or controllability. Budget revisions, it means you have to go back every once in a while and adjust the budget as needed. And rolling budget concern periodic budget updates. We'll talk about those in the next session. What should you do now? Go to Farhat Lectures, look at additional resources, whether you are studying for your CPA exam, CMA exam, CIA exam, professional certification, accounting courses. Farhat Lectures is always here to help.